Welcome to BTFDtv. My name is Jack Barnes. And if you've been following the equity markets at all lately, you'll know that the markets are in turmoil for the first time in years. We're having our first, what appears to be authentic correction in quite some time. And we are blessed to have the one, the only fall slinger joining us in our virtual studio. Sir, welcome back. It's been a while since you've been here, but we haven't really had anything to talk about. The moment things got exciting, I reached out and you kindly said yes. So welcome back, sir.
Thank you. Good to be back. It's exciting to have something to talk about again for a change. It's always more fun when there's opportunities, even though it might be scarier at times as well.
Yeah. I mean, look, I'm going to go on the record now, since this isn't Twitter. And we all don't lose here. I'm going to say that I had a very good summer going until about last week, and I have not added any value to my personal portfolio when looked at in the curve of the summer. So there's no back padding coming from this corner. I will say that it has been a long time since the markets were this fun, and while I'm down, I'm not complaining, nor am I in any way feeling panicky.
Well, I think the most important thing to always remember is no matter what, most of us who are investing are doing so with a very hopeful long-term time horizon. No one's planning on cashing in and moving out anytime soon unless you need the money for a purchase of something like a home. So, I mean, the reality is times like this, even though they're scary and you probably see dramatic losses, whether it's in your 401k or your personal accounts or your funds, this is really when cooler heads need to prevail, and you need to think about the long-term opportunities, because the reality is you don't get long-term opportunities unless there's turmoil. So it should be embraced.
Alpha comes from blood in the street, is my opinion. And it appears that we are at least looking like the streets might, the drought might be over for a little bit. Let me put it that way.
Yeah, I mean, what we witnessed in the last week is, relatively speaking, I mean, depending on how you want to look at it, you could actually use the term unprecedented. I don't know that I would, but I mean, listen, the VIX in and of itself was up over the last 5 days more than it's ever rallied in a 5-day period. Now, having said that, the VIX is only 25 years old.
Right.
Look at it on a different time frame, like 3 days. The answer is this has happened before, so it's all about your frame of reference. But it's certainly a unique opportunity in unique times right now.
Where are you seeing? I'm going to dive into your view of the market at this moment. Where are you seeing the first signs of And I'm not asking for specific names, just generic.
Well, I would tell you I've been pretty bullish. I felt like the pain trade was higher, and I really thought summer would be calm and quiet. Clearly, anyone who follows me on Twitter knows that those have been my views, and I'm the first to admit that I was pretty wrong, evidently this week. I will say the two things I had been advocating for were one, calendar trades, which were typically short gamma, long vega. So, those got hurt pretty badly because the gamma profile got pretty vicious this week. Having said that, the vega profile helped offset a substantial part of that, which was fortunate. The other thing I've been advocating, I had mentioned, I blasted out on tweet, after this most recent earnings period, earnings were supposed to be such an important data point this year, specifically this quarter, with the expectations that the Fed would be hiking and everything else. And, earnings came and went. They were, for the most part, fairly decent. Part of that is because expectations were fairly low. But was the implied correlation after earnings had remained unusually low. And that's partially a function of the fact that we really just hadn't had any volatility in a long time. And people who had been for years now buying protection and hedging their overall individual stock portfolios with index puts probably finally got to the point where they were throwing in the towel and decided, the idiosyncratic risks that
was me at 06 and 07. Yeah. I bought insurance all through the ladder up in 06 and the beginning of 07. I was just like, what the hell am I doing?
Right. You don't get paid. And I think, people had realized that, relatively speaking, hedge fund performance this year had been pretty tough. We'd seen a lot more outsized dramatic moves in single stocks. And this year really has been a year of alpha and stock selection. So I think that combined with history probably led to a lot of people discarding index insurance. And that's probably why implied correlation remains so low even after earnings, because it usually does pick up post-earnings cycles. But nonetheless, that was something that I mentioned literally a week ago. And unfortunately, A, it couldn't have been timelier, and B, unfortunately, I didn't monetize it like I should have. But hindsight's always 20/20, so.
So it appears that China's down another 4.7 while we're chatting. Thoughts on Asia? Let's just, because I'm old enough that I remember the Asian contagion. I started on the street in '97 and found myself trying to answer why Asia was collapsing as my rookie job.
Well,
I was in fund information at Franklin Templeton. Bonds in Asia, boy, that was fun. And then obviously we rolled right into long-term capital, which was pretty much a whole blast the whole time I was there. From your perspective, thoughts on Asia and the devaluations that we've seen already, the devaluations that probably are in the pipeline?
I mean, my thought is there are two things going on. The first and foremost, though, you have to separate the Asian economy from the Asian stock market, because the Asian stock market is not the Asian economy. Those are two entirely different things. So, people who are looking at Asian markets and using that as a reflection of what's going on in their economy are probably deluding themselves and fooling themselves into making maybe not short-term, but certainly medium-term and longer-term investing mistakes. So I think it's important to separate those two. I also think whenever you talk about Asia, and specifically China, you probably have to be very careful, because there's no secret that what we are told and what's accurate are two different things. We are lied to quite frequently, and that's okay. There's nothing wrong with that, as long as you understand that and accept that and take everything with a grain of salt. So having said that, I will say Asia concerns me, but not really, because at the end of the day, this is and has been a commodity-led recession that we've been witnessing. We've been witnessing it for the most part, the last 3 years. I mean, you pick your favorite commodity, whether it's mine, which is gold, or crude.
We'll be coming back to that topic, so I will return to that. Continue on, sir.
Or copper or anything. There's been a pretty obvious pattern for the better part of the last 3 years, and that's been slowly moving down. And an economy like China or Asia, or some of the South American countries that are driven by commodities and tend to be closely associated with those. So China, Brazil, some of the South African countries, it's not surprising to see economic weakness, because they're simply following the price of commodities. And it kind of becomes a snowball effect, right? You have those going down, so demand gets lower and things snowball. But the other thing is, obviously, we don't really ever know what the real demand is, right? I mean, how many ghost cities are there in Asia? How much overbuilding transpired? I mean, I forget the exact stat, but there was one stat that was kicking around for a while, talking about, I think I want to say it was like in 6 months, or maybe it was 6 years in 2014. So let's call it 2008, 2014. China used more cement than the world had ever used, or something ridiculous like that.
The U.S.
Yeah.
I remember that one. China has put more concrete into the ground in like 10 years than the U.S. has in its history.
Right. I mean, so, a lot of, obviously, their demand, I wouldn't say it was artificial, it was real, but it was, they were basically building cities to then rip them down and rebuild them to stimulate, whether it was lending or construction or jobs. So I don't really worry about China. I mean, everyone wants to look at it, but listen, at the end of the day, they make cheap goods.
Yes.
And those of us who are here in America are going to benefit from that. We are not really relying on China to consume the services that we, generally speaking, produce, because we're not really a production company. We're, a country. We're a service company. We produce, consumer stuff like HR and tax services. We're not out there producing goods. You know, we're not producing computers or whatever the case may be. So I don't really
Yeah,
worry about.
Packard. Did you hear that one? She's going to chop it in two.
Yeah, I've heard that a while.
And Packard.
You know, so I don't really worry about their economy in the sense that I think it could drag ours down. You know, again, this is a commodity-led recession. This is nothing like a bank-led recession like we saw in 07, 08. You know, I'm not concerned yet about the balance sheets at the major financial institutions. You know, having said that, are there financial institutions that are probably overinvested in parts of Asia and are going to take some lumps? Sure. You know, and that's the case for banks. That's going to be the case for some hedge funds. But the reality is their economy can't, I don't think, you know, completely get us to the point where we're worried about hunting for squirrels to eat. And that was the case in 2008. You know, you were worried about there being zero financial markets ever again.
Yes.
So, I mean, yes, is China important? Absolutely. You know, they're the fastest growing economy in the world. They're probably the largest economy in the world. They certainly have the largest population, and they probably have the largest percentage of lower class and middle class. It's about to become middle class and upper class. And so a tremendous amount of demand has been coming from there and will continue to come from there. And that's where a lot of the growth is for a lot of the important key US companies. I mean, you look at someone like Apple. Apple is selling more phones in China now than anywhere else, right? And tremendous growth over there. And that's something that has been embedded in the stock price and continues to drive, or had been driving, you know, the bullish talk there. And certainly part of the recent pullback in that stock is probably related to concerns over continued growth of the middle class and therefore their ability to purchase an iPhone or an iPad or whatever the case may be. So there's no doubt that it's important for growth, but it really doesn't affect, you know, Goldman Sachs or any of these other institutionally important companies here that could drag this market down because of some off-balance sheet crap. So, I mean, I worry about it. I'm invested in a lot of those types of companies because in growth, but it is what it is.
I'm going to bring us now from Asia to what I call the New York Fed, although theoretically they're based out of DC, but New York does the actions. Thoughts on a cut, no cut, when there's a cut?
Well, I think the market, the FOMC minutes we got on Wednesday is, in my view, what got this whole ball rolling. I think the market was finally ready and finally prepared for a September hike and dovish tones so that the market would have understood this was a one and done and nothing else going on. And when you saw their commentary, it was clear that that wasn't the case. And I think that unsettled the market because there's nothing the market and investors dislike more than uncertainty. Left it uncertain. And now we're worried about double talk and can they be trusted because everything they've told us has been called into question. So I think that's really what got the ball rolling into Thursday and Friday, more so than anything going on in China or anywhere else. My view all along, and I would say falsely up until recently, was that they would not hike. I feel like we are in a catch-22 where they pretty much can't ever do that again. And the reality is, even if they hike by 15 basis points or whatever, it's a token, you know, who cares?
I'm going to annoy you. I believe that she should do 50 bips, one, and then done for probably post-election. And that gives 50 bips would give her credibility for scaring the market in any need in the future and the ability to even back it back down if necessary.
Yeah, I mean, listen, again, the reality is we're talking about rates going from 0 to 50 or 0 to 25. I mean, it's such an irrelevant number for those of us who have been around for a long time. I mean, talk to people who bought a home in the 80s and were paying 14% on your mortgage. Like, it's almost comical that we spend so much time analyzing what really is such a meaningless number in the grand scheme of things. I mean, we are still so far away from the historical norm, let alone, you know, where things could be, that it's just silly that there's been so much focus on this. And that's why I felt like the Fed should have just done their 15 or 20 or whatever it was, and then spoke dovishly, and we could all be like, okay, they have credibility. They did what they said they were going to do. Now let's move on. They can't do anymore because the reality is we won't be able to service our own debt if they did. So it's that to me was very disappointing. I think now you certainly are getting. I would say on Wednesday all the talk was okay, and even Thursday. Well, now we'll get in December, and I feel like from what I saw on Friday and commentary over the weekend, people are calling that into question now too, rightly so. It's kind of scary though that a 6%, 7% pullback in the market from the all-time highs, and you're probably about to have QE4 called for. It's farcical to say the least, but that's the problem with how we handled the last financial crisis, and that's part of the issue of why we are where we are today.
I have our first question.
Yes.
This one's about oil.
Okay.
And saw a chart today where almost all U.S. job gains in the past several years are in this space related with this crash. Thoughts?
Well, I think this crash is not something that,
I'd say the crash in oil, just to be clear.
Yeah,
Sorry.
no, I know. I don't think the crash is that important. I mean, let me rephrase that. It's very important, but you say crash. Are you talking about the crash from $45 to 40, or from 90 to 70?
I'm talking the implications from 100 to now. We've cracked in the 30s tonight.
Right. Yeah, I saw we hit 39.60 or so. I mean, the reality is, again, we've seen this coming for a while. It's not like we crashed. We've been slowly dropping for the better part of the last 18, 24 months. So, if you're a producer,
back since '86.
Yeah, if you're a producer in the Bakken, you've cut production long ago. You've stopped hiring and spending $150,000 for unskilled laborers to come and help you out. So, is this bad? Sure, but I mean, it's bad if you're a producer, but it's pretty damn good if you're a consumer. I mean, if you drive to work every day, you're making out like a bandit. So, I mean, I don't necessarily think it's a bad thing. Again, this is a commodity-led recession, and, there are always two sides to the coin. So there are plenty of people and institutions that are benefiting from this significant drop. So, I mean, again, you had plenty of time to prepare, and if it went from 60 to 40 overnight, we'd be having a much different conversation. But the fact that we've been pretty much, had a pretty volatile path to get here, but a steady, slow decline over the better part of the last 18 months, isn't to me a crash by any stretch.
Okay. Let's talk pain. No names, but I know that you talk to friends in the industry, and this August appears to be the first time Hedgestan has had pain in August since '07 when we had the Quanticide like this. I mean, I don't remember a more bloody August since.
2011 was pretty bloody for a lot of people.
Oh, that was true. I made money on that one, so I didn't think it was bad.
I mean, listen, one of the things we've been noticing for quite a while, and I remarked a couple of times on Twitter in early August, was that August was already shaping up to be an incredibly painful month. The indices for the first part of August, call it the first 2 weeks, didn't really budge. But if you looked at the individual stocks that are on your typical VIP basket list from major banks or the most heavily owned by hedge funds, whatever you want to use, you saw a significant amount of them acting very, very poorly, and it was it was partially due to poor earnings in some cases. It was also partially due to what typically happens in the summer, which is your typical hedge fund manager wants to go on vacation and not worry. So you de-risk and you take down gross and you take down nets. And what happened was, again, we were in an important earnings season. Guys were taking down exposures, and a few too many probably started acting too fast, and no one knew what was going on. And so they started getting out, and you had a couple stocks really just get destroyed. And these are the stocks that, had 35, 40% type of hedge fund ownership. And you get one of those stocks and one big guy who's, got 10 billion in AUM coming out of it, for whatever reason, whether it's because he wants to take vacation or because he's returning money to outside investors, or because one of his portfolio managers is sick and taking a sabbatical, they start selling, and next thing you know, fund XYZ hears about it and they start selling, and things snowball and they get out of control. And that's how stocks, that combined with poor earnings or low visibility or a lack of faith in management, you go from, being a $35 stock to a $10 stock in the matter of 2 weeks. So I think August was already a very, very difficult month for a lot of funds out there prior to this past week. I think this past week was, I don't want to say the word capitulation, because I think we probably have an opportunity to still go lower, but I think it was certainly a reflection of people just saying, fuck this, and throwing in a towel. What are we doing? I think the numbers we're going to see, assuming, let's just say the month ended today. Obviously, we still have a week left, but I think the numbers you're going to see this August are going to be probably the worst performance metrics, regardless of the type of fund you are, unless you're a short-only fund. I think it's going to be the worst numbers you've seen, at least since 2011 for any single month, and probably since 2008. I mean, I think the macro guys are probably hanging in there okay, although they probably got blitzed on Europe because a lot of them have been long Europe and long Japan. And they're some of the guys who are probably pressing the US here. But the event guys have kind of gotten snowballed, the value guys, the growth guys. There's just been a lot of individual idiosyncratic tape bombs that, they just add up and they add up, and it's going to be ugly. I can't wait to actually see the numbers.
All right.
Because I've heard some preliminary numbers, and they're certainly the worst I've heard in at least 5 years, and quite possibly 10.
Interesting.
Yeah.
That makes me smile. Sorry. So where is the safe trade? I have an opinion, and it's one that has not played well for the last 3 years, but to me appears to have contrarianism in it at this time. Thoughts?
Well, I don't think there's ever any safe trade. So I think that's probably the wrong thing. I think the trade where you're least likely to lose money in the short term and hopefully make, there's probably a couple. I mean, there's no doubt that I'm a gold bug, and I've been that way for a very long time, and that's been very good at times and very bad at times. I think the way that metal has finally acted this week is a positive and productive. But having said that, the last 3 years we've been fooled a handful of times, to say the least. So it's hard for me to want to talk too much about it and get excited, because I'll just get kicked in the teeth again.
Don't bring it up, Barnes. It's working. Shut up.
Yeah. But I mean, listen, I think there's a lot of, let's call it safe opportunities. It all depends on your time frame. To me, buying, and I'll talk about this company because, again, it's the largest company in the world, and I'm not going to move it, and it's kind of irrelevant. But like Apple, look at a company like Apple that's trading at whatever it is, like 107, I think. They got $25 in cash. They generate $10 a year in earnings. So you're buying a company ex cash at like 8 times earnings. Yeah, are there concerns about growth slowing in China, and that's where their demand and growth has been mostly coming from? Sure. But, that's a company that I'm willing to bet on for a very long time. And I feel like if I can own it at 8 times X cash, I'm okay, even if it goes lower. Like, does it go to 6? Does it go to 5? I don't know. Maybe it does. But you know what? If that's at 5, where do you think these companies that are trading at 40 or 50 or 200 times PE are going? So I don't want to say that it's safe, but I think that's a company, that I personally am buying in my 401k, and I feel like it can add. And there are trades you can do to express what I would call a safe bet if you are option savvy in different time frames to take advantage of that. Where you can make money whether the stock goes up or down from here, and that's fairly unique and doesn't present itself often, but it does present itself once or twice a year. And this is one of those times where you can do some pretty savvy trading and have a zero risk, and I don't want to say guaranteed, but you're going to make money 999,999 times out of a million. if if you look at the option market and know how to take advantage. So I like that. Right.
All right. Where's the pain trade going forward?
Well, I'm going to sound like a broken record, but I really believe the pain trade is higher. I think if you look at the numbers we have been seeing from all the prime brokerages, the major prime brokerages here in the US, whether it's Goldman or Morgan Stanley, they all have been showing for the better part of the last 3 to 4 weeks that net leverage has been coming down. That was coming down, as I said, partially because it's that time of year where people want to go on vacation. They want to have less risk on the books. It was also earnings season, and typically people take down risk into earnings because they don't want that idiosyncratic risk. And lastly, I think there was some concerns overall about the market because we've been trading sideways for the better part of 6 months. So guys were taking down net. And then over the last week, we had what happened, and you had a major gross down because gross and net are two very different things. So now we are in an environment in which, net leverage has come down significantly. The gross leverage has come down significantly. They are still, relatively speaking, closer to highs than they are to lows if you have a 10-year history. But if you have a 2 or 3 year history, they're well off those highs. I think the worst thing that could happen to this market from a hedge fund standpoint, so let me caveat it that way, but if you're a hedge fund guy, the worst thing that could happen right now is we get a rally back to the highs or through the highs, because what's going to happen is you are going to be forced to be buying 5% higher from here. And that creates problems when you're talking to investors because, why were you selling with the S&P at 2,000 but buying at 2,100? That doesn't make sense. And it's a difficult conversation to have. So I really do think the greatest risk is a move higher. Yeah, I think the greatest risk is a vicious V-shaped type of recovery, especially because we're in the part of the season where, as I said, liquidity is significantly lower because it's summer, volumes are down. You have the hedge fund community, which has de-risked. You have the corporates, which have been fairly strong on the buybacks now that earnings seasons are behind us. And so what happens if we get a V-shaped recovery, it's not going to be led by the hedge funds. It's going to be led by corporates buying back and some institutional money. So suddenly we're going to be, 3, 4, 5% higher. And all these hedge funds I just puked are going to have to buy it 5, 6, 7, 8% higher. And it's like, apparently they're not getting the memo to channeling.stocks.com and buy low, sell high. But
thoughts about the 10-year being at 2%?
I don't really know what to say there. I mean, listen, at the end of the day, I think you're out of your mind to invest in something that's going to only yield you 2% over the next 10 years. Having said that, I can understand the attraction for some people. I would say reality, it's a really good thing if you're, an individual with a little bit of wealth and the opportunity to borrow and leverage, because I really think if, you're in that situation, you probably also have the opportunity to do some work to understand risk reward and then know where you could probably generate a little bit greater yield. I think it's a really good thing for America. I think it's, one of those things that, I don't want to say economic boom, but it's certainly going to be helpful for the housing sector. Home ownership, as we've seen, has been declining precipitously over the better part of the last, 20, 30 years. I think it's a good thing. I think it would be a real net positive to see home ownership trends reverse and start going higher. And I think one way that happens is lower and lower interest rates to borrow money. So we'll take the 10-year at, listen, frankly, I'll take the 30-year at 2.5. That'd make me very happy. But if you're thinking about it from a perspective of, investing your money and having that guaranteed return, it's, not exciting and obviously a sign of fear. But like I said, if you're in a position to use that to your advantage because you can borrow, it's a totally different story and you should be embracing it and very thrilled with it. And again, I think the U.S. has backed itself into a corner. where we have so much debt outstanding that we can't really go back to the way things were 20, 30 years ago and be paying 4, 5, 6% because we won't be able to service our debt. The good thing is every other country in the world is also debasing their currency, and you've seen easing out of everyone everywhere. It's kind of a good thing because it allows us to sit on things and not necessarily ease, but have implicit easing driven by everyone else. So that's a positive.
Where do you like the market right now?
Where do I like it? The contrarian in me really, really wants to buy oil-related companies. They have, I honestly don't even know if in 2008 the financial stocks had this much negative sentiment around them. Having said that, it's been the very right trade, and we have not seen enough of those companies file for Chapter 11 yet. There's a lot of overly levered companies that are in big trouble, and that with oil prices here and treading water here for the better part of the next 6 months, year, or whatever the case may be, they're just not going to be able to generate enough revenues to cover their costs. So I'd like to see a few more companies go out of business, but again, I've never seen Wall Street so negative and so one-sided and so much strength in their belief. And it comes from the sell side. It comes from the buy side. It comes from the specialists and the generalists. So I really want to buy these companies, but I know I can't because I'm not that brave. But I think if you have a 10 or a 15-year time frame, you can start buying these companies. You just need to really be able to do your work and understand who has what kind of debt level and how their ability to service that debt is. So you really have to do focus on best of breed. And it's a tough sector to do that because it's not best of breed just on management and just on how much leverage they have, but it's also best of breed in where they have their land and where their production is. There's been a huge change in which is the areas that you want to own wells and service things. And that's, all changing for a variety of reasons. You had the new refinery come on down south or about to be coming on. So that changes the whole storage implications. So it's a sector and not for neophytes, and you really have to do your work. But that's one area I like. Obviously, I think there's some opportunities in large cap tech. I wouldn't go crazy there, but there are some GARPy type of names that you can own. There's obviously a clear trend in media, old media versus new media, that a lot of people have been involved in, and that has been working very well of late and has really only started to waterfall, so to speak. So that's an area that I think there's good opportunity for 10, 15 years out. But if you're looking 1 month or 3 months, I have zero clue. I mean, the way I try and invest is thinking about where things could be 5 or 10 years from now. Because the reality is, as we've all learned, trying to guess which way the market's going and which way the winds are blowing on any given day or week or month is a very difficult thing. And just when you think you have it figured out, you get kicked in the teeth.
All right. We have another question.
Sure.
This one is, how can we have more housing without a 20% down payment and low household formation?
How can we have that?
Yes, what the question is how are we going to grow our future housing stock?
Well, I mean, the answer is, future housing stock is development. Those are two different things. Interest in ownership. I think, one, there's a tremendous amount of programs out there that actually allow people to put less than 20% down. If you're buying a $1 million home or a $2 million home, or and you're living in New York City, yeah, you have to put 20% down. But the average home in America, I think, is around 160,000 if you look at it across all of America. And there are plenty of programs elsewhere that really, I hate to say it because it brings you back to the 06, 07 timeframe, but where you really only need to put 2, 3, 4, 5% down and you can own a home. And the reality is, if you're an average American buying an average home at the average price, then you should be able to, I would hope, have enough money, saved up. Because the reality is, listen, if you're going to be buying a home, you need to realize there's a lot of other responsibilities that come with owning a home and a lot of other costs. So you should not really be buying a home and hoping that your boiler doesn't break or, your mailbox doesn't get knocked over.
Cost of carry.
Right. There are other things. So I'm not worried about it in that I think there are plenty of ways around putting down 20% to own your home. If you're not buying a McMansion and you're not living in New York City or San Francisco or Miami. And clearly, if you look at the averages across America, that isn't America. So, I think it's all relative. But
I saw a VC post on Twitter today, and this was his idea, and it was Uber for Airbnb. So basically, a RV drives by, picks you up, and gives you a place to sleep while it drives around town. I mean, that's how bad it is in San Francisco right now for trying to find housing.
Yeah, I think I was reading that it was one of, if not the most expensive city to live in, which is pretty wild. But yeah, I mean, I think it's all relevant. I really just don't think you need 20% down. I mean, yeah, it's like I said, if you're buying $1 million apartment in New York City, you probably need more than 20% down because it's probably trading for all cash to, some foreign buyer who's looking to diversify. But, the reality is in America in general, you probably don't need that much. I think there are plenty of programs out there, compliments of the U.S. government, that allow people to put down around 3.5%.
Okay. Last question. I want to thank you. You've been fantastic, and I want to invite you back again, obviously. But this one question would be thoughts on tomorrow.
Well, if you're going by futures indication right now, we're down about 0.5%, which realistically, considering the move on Friday, isn't that big of a deal. Listen, I'm bullish. I think the opportunities lie higher. Did the bottom happen on Friday? Is it happening tonight? Is it going to happen Tuesday or Wednesday? That I can't answer. I think the most important thing is, to know what you want to own and when you want to own it. I think something I've been saying all year, and I'm not the only person who's been saying that, is it's incredibly important to know not only what you're invested in, i.e. what company, but who you're invested with. Liquidity is obviously a premium, and it's a premium worth paying. And you always need to know who else you're invested with, because the last thing you want is to be put in a position where you own something that's going lower and lower, and it's not going lower and lower for any reason other than it's illiquid and there are forced people who have to sell. I will be.
That's the pain trade. There's nothing worse than being in something illiquid as it drops and you can't get out.
Right. So, I mean, I'll be putting money to work. I've obviously been putting money to work. I continue to think there's plenty of opportunities out there. And again, it's important to realize that there are different types of investing, and this might be the time to invest with a 1 month or 6 month or a 1 year horizon as opposed to a 1 hour horizon, which a lot of people seem to have. Everyone wants instant gratification, and that's just not the way things work in the real world usually. So, I mean, the way I look at it is whether we're down 0.5% or 5% tomorrow, it's kind of irrelevant. No matter what, even if we're up, there's going to be opportunities on either side. I think the obvious trade in the next couple of days is if and when we rally back towards the 200-day because of the technical damage we saw. There is going to be a tremendous amount of people trying to fade that. So that is going to be a level that's very much worth watching. If we rally back to the 200-day somehow and we can't break above it, it's very possible to see people press it and push it lower. If something comes out, whether it's China, cut or some other unforeseen piece of news that moves the market and we are gapping above the 200-day, you might see a tremendous amount of people being forced to cover, because I bet there's a lot of stops from the shorts around that 200-day. So that's a level that I think is very much worth watching in the near term. But, you know,
Sorry.
but I think you want to focus on, you know, single stocks. And I think, like I said, there's a lot of companies out there that, you know, you can look at and take advantage of, if depending on what your time frame is. And so it's hard for me to give advice to anyone because I don't know what everyone's time frame is. I can tell you from mine, you know, a company like Apple, to me, both in the short term and the long term, is attractive. And there's a lot of companies like that right now. So.
One last question from me.
Sure.
Thoughts on Alphabet?
Obviously, you're talking about Google. I think that was a very good step. Investors for a very long time have wanted transparency and accountability, and that was always a concern when it came to Brin and Page. They have built a tremendous company, and they decided that they wanted to spend a lot of their money, or I should say their investors and shareholders' money, on pet projects. And those pet projects are very important. They, you know, to a certain extent, in some cases, are trying to change the world one little step at a time. But, you know, I think that's okay if you're a billionaire and you want to do that with your own money. I think if you want to do that with your shareholders' money, that's a different thing. So I think, you know, this was step number 2. Step 1 was bringing an adult in Ruth Porat, who's going to be very shareholder focused. Step 2 is providing this corporate change, and because that's really all it is, which will allow for a greater amount of transparency and accountability. And, you know, that's not going to change them from investing in the Google driverless car or, you know, any of their other myriad of products. But what it will do is allow us as shareholders to see how much they're spending and where. And, you know, it allows us to determine, you know, is it reasonable for them to spend $3 billion or whatever it is on the Google driverless car project, you know, and look at it. And if it's not, we can now be able to go to them and say, hey, we don't like this and this is why, and we think you're throwing away money. Whereas before, we had no idea. So I think it was a very smart change. I think it's exactly what shareholders wanted and needed. I think it kind of removed one element of the bear case. The next question is, you know, this was only one step. There's still plenty of steps for them to do to regain our trust as shareholders. But again, I think bringing Ruth in, you know, was them showing us that they're going to do this. And this was, you know, step number 2 in showing that they are committed to this. So now we'll be looking for steps 3 and 4. And that really, you know, will start to come through, not on this next quarterly earnings call, but on Q4 call when they actually start breaking things down. But I really like the move. I applaud the move. I think it was, you know, if you are an activist investor, which I certainly am not, but, you know, the activist types, the Carl Icahns of the world, or, you know, the Ackmans of the world, people would applaud this move, because all you could ever ask for is transparency and accountability to management. You know, management can make mistakes, and they will make mistakes, and they do make mistakes, you know, but allowing us to see them and as shareholders make decisions about their future based on their track record is what you want. What you don't want is someone just saying, yeah, everything's fine, or, you know, this is our company, we're doing it this way, and you have no say even though you give us your money. So it was a great thing.
Thank you, sir.
Yes.
It's been 45 minutes. I look forward to you returning soon. Hopefully, maybe 6 weeks, 2 months from now, when we've had some clarity of August.
Yes, absolutely. I look forward to being back. Thank you for having me. I would say to everyone who's out there listening, get some sleep. It'll be an interesting day regardless tomorrow and the next few days. And just try and remember that through carnage lies opportunity. So, you know, think about the long term and try and be as emotionless as possible, because there are opportunities out there, whether you're a bear or a bull, and try and take advantage of them, because opportunities like this come around maybe 2 or 3 times a year if you're lucky. So this is one of those
we've
times.
gone a few years without this much fun.
Exactly.
Thank you, folks. This is the end of this special episode of Markets in Turmoil with the one, the only Volslinger. My name is Jack Barnes, and BTFDtv will be returning after Labor Day with a whole bunch new of episodes on Sunday. So please join us again soon, and thank you for having watched this episode.